Okay, our first example, calculating rates of return. So this question is asking us to calculate the income yield, capital gain yield, and rate of return, the overall rate of return, in 2008 for Cameco. You can see all the numbers in the description. I've already started to list them here. We have basically actual data for a real Canadian company. They process uranium for the nuclear industry, so I happened to work there briefly for a co-op job back when I was at school. So the share price at the end of 2007 was $39.57. At the end of 2008 was $21.05. And at the end of 2009 was $33.93. Dividends paid in 2008 were 24 cents and 2009 was 24 cents. Okay, we have extra data in there you don't need. We're looking at the year specifically of 2008. So the share price at the end of 2007 is the price at the start of 2008. So that's the price we purchase at, VI 39.57. And then at the end of 2008, we're curious about the rate of return that year. So we're going to look at it as, we'll look at it as what did the stock price do that year. So to the end of 2008 was 21.05. We'll consider that to be the price you would be selling at if you're trying to calculate how did Cameco perform that year. And the dividend paid was $0.24 or 24 cents. Feel free to work along with me, or go ahead and pause now and just try. If you looked at the equations in the previous video, just give it a shot and actually see if you can calculate the three numbers. It's worth the practice. Alright, let's try it out. So we really are just going to plug them in. I'm going to do income yield first. It's what it asks for. It's fairly easy. So percent I is going to be equal to, well, whatever our income is. You know what? In this case, I'm going to say income. It's like I say, they call it dividends. If you put dividend or income, that's fine. So I'll say income divided by the purchase price, VI, or that's equal to, well, dividends over VI, either way. And in both cases, yes, we're going to turn it into a percent afterwards. But so percent I is going to be $0.24 divided by 39.57. And then yes, we'll times that by 100%. And that gets us a positive rate of return. So you don't have to say positive if it's a positive number, but sometimes I like to just emphasize that, of 0.61%. Remember, you can always kind of keep an eye on the answers and make sure if they make reasonable sense. 0.61%, okay, so a little under 1%. 1%, so 39.57, so $40, 1% of $40 would be, move the decimal point over two places, it'd be 40 cents. And we earned 24 cents. So yeah, around 0.5% sounds about right. So just eyeballing it, just ballpark with with math skills we know, saying, does that sound like a reasonable number? It shouldn't have been 6% or 0.06%, even smaller. So yes, in this case, they paid out around 0.5%, sounds reasonable. 20 cents on $40. $40, 1% of that would be 40 cents, and half of that would be 20 cents. So anyway, you don't just in case. I hate to see people, at least if you show me this work and then you did have the wrong answer, I know you just hit a typo somewhere by mistake. But it's nice just to have that in the back of your mind, thinking, did I get about the right answer as I go? Okay, so we earned 0.61% on the dividends that year. That's pretty good. let's look at, so zoom, let's look at the capital gains. So you can do this in multiple steps if you want. Actually, I meant to, 1 second. I have the final answer, but I did want to check. Okay. Yeah, I'm going to do this in 2 steps just because I really want to drive home the gain. The gain or loss itself is just the difference in the prices. Oh, by the way, if you're ever doing these sorts of calculations, and if it talks about owning multiple shares of stock, we're always interested in just the percentages overall. So you can do all these calculations just based on 1 share. You don't have, even if it said you bought 100 shares of stock, you'd just be multiplying everything by 100 and then dividing everything by 100 at the end. It wouldn't matter, it would all come out. So sometimes we do say that because realistically you might actually have done that, bought more than 1 share. But if we're interested in just the percent return overall, you can do all the calculations just based on 1 share. Assuming they haven't told you on the 100 shares you then earned $24, 100 times. Well then yes, you might have to divide by the 100 to start. But yes, even if it said 100 shares of stock, but then it gave me these 3 numbers, I could just use those 3 numbers. I don't have to take into account that it's 100 shares if I just want to find out the percentages. Now the capital gain, the amount of dollars you actually gained or lost, you could say you would multiply by the 100 shares. But let's calculate this. So capital gain, dollars. So the dollars of G is just VF minus VI. So that is 21.05, the selling price, minus 39.57, the purchase price, which is a loss of, so it's negative $18.52. So you may have seen that coming. This was not the best year for the company, apparently. The stock price dropped almost in half. Let's turn that into a percent rate of return. So like I say, we're gonna do, so percent G is gonna be equal to VF minus VI over VI. I'll do the times 100 at the very end. So that's negative $18.52 divided by $39.57. And you didn't have to do the capital gain part separately, but it's kind of nice just to see what happened. Oh, it was a loss here. So you put them together, and what do you get? And once you turn it into a percentage, you get a loss of, so negative 46.80%. So yes, if you bought at the start of 2008 and sold at the end of 2008, it wasn't the best year for you, unfortunately. Maybe you sold because you thought the price was just going to keep going down. It's so difficult to time the markets. This is why, if you ask me, some of my savings are invested in index funds, which more broadly distribute my investments, and they're invested for the long term because buying and selling is very tricky to get lucky. Everyone wants to sell when they see it dropping, but if it's dropped, you don't want to sell. But then again, sometimes they never come back up. Some companies just go and crash completely. You may remember a company called Nortel, Northern Telecom. It was really big here in Canada in the late 90s and early internet boom and everything. And then it went from a share price of over $100 per share to basically like $1 or less. It just went back, just crashed very quickly in the early 2000s. I think 2001, or it might have even been 99 or 2000, something like that. So, yes, it's hard to tell. So, okay, third bit. The overall rate of return. So like I say, you can just add the numbers directly here. I'm going to do that for ease in this case. So the ROI, the return on investment, since I didn't have room to write it on the board in the last video, is just going to be equal to percent I plus percent G. And so that's going to be 0.61% plus, or sorry, in this case minus, because it's a negative, so minus 46.80%. And so you'll get minus 46.19%. This case, if you held on to all your decimal places, you actually would get minus 46.20% here. So, or if not rounded, early, it was negative 46.20%. So slightly, just, yeah, it's one of those, I'm saying I'll give you both. In this case, you know, check, I would give you full marks for either answer, because the one of them you are just taking these two numbers and adding them up. The other one, if you are going back to actually adding up 24 cents of income minus $18.52 loss, you will see, you know, and then divide by 39.57. So if you go with the most accurate set of numbers, it will give you ever so slightly rounded different number here, but that's okay. In fact, I'm just wondering, yeah, so just to show it for interest's sake, ROI here in this case, yeah, so 24 cents minus 18.52 divided by 39.57 and then times 100%. So yes, like I say, if we do it this way, I think we actually do get negative 46.20%. So just the slightest of rounding differences, but I would give you the answer either way. I'd give you the full marks. Normally I don't like you to round early, but in this case we're specifically asking you to round at each of the steps. So doing that third step using the rounded numbers, it's okay. It's such a slight difference anyways. It shouldn't be off by more than 0.01. If you're off by more than that, then maybe you made a mistake somewhere else. So definitely keep an eye. But yeah, so we just calculated the rates of return. Like I say, we made 0.61% on the dividends. We lost 46.8% on the investment itself, the capital gain part, buying and selling the stock. Buy high and sell low, which you don't want to do. And so overall rate of return, we can just add them up for a loss of 46.19% or 46.20%. Next, we'll try to take this, and like I say, if we know we want a 10% rate of return overall, and we have details about the starting price and the dividends, can we figure out what that ending price would need to be? So you can pause the next video at the start, or just look at the numbers on the worksheet and give that a try first if you want. See if you can fiddle with that and figure out a way to get there by juggling around the equations or what have you. But I'll try to show you what I consider maybe a slightly easier way at least.